Your birthday? Thank you.
First of all, this is our first event in the course of our open lecture to be held offline. So this is really something new to us, new format, and we are very glad that so many of you joined us. First, the second thing, David is our future teacher who's going to profess course on risk management next year. David has been working in risks in banks for over 35 years. He started in 1987 in the UK. Then he had various employment with different investment banks in the UK, in the North American countries, back in Europe. He had also worked in a regulatory authority in the UK, supervising investment banking industry in Great Britain, and since 2009, he is working for Russian banks. He started with GD in London, then moved to Moscow, and since 10 years, he is working in Moscow, in Russia. And considering that the good part of our students that bankovskих finance would like to build their career in investment banking, I think it would be really interesting to you to listen to that and know more about experience in investment banking. So I now turn it over to you, David. Thank you very much.
Alexander, thank you. Look, firstly, thank you for so many of you turning up. It was my request that we did this live because, to be very honest, I haven't done a lot of public speaking for many years now. And I think for me, it's very important to get feedback. So I'd like this to be as interactive as we can reasonably make it. And after the session, in whatever form the school can collect feedback, if you can give me your comments about the presentation, my style, was it understandable, was it useful, that would be very helpful to me. So any of you who are going to be my students next year don't have to suffer twice. Okay? So for me, it's also a very important part about building experience. I do speak Russian to some extent, so if there is difficulty in asking questions in English, it's okay to try in Russian, and I will probably answer in English, but don't worry if there are any difficulties. Risk management isn't necessarily the most popular subject. I mean, we risk managers are thought of as being a little bit dull, perhaps, not very interesting people. And so when you read every day on the front page of international newspapers, the FT probably has been an article in The Economist, if there hasn't, there will be, about issues with risk management in major international banks. You understand that this is not praising a CRO who just saved his bank from failing, but rather it's yet another series of articles of management. And all of this started happening as I was writing the presentation. I decided not to put any material directly about any of these events into the presentation, but I do want to refer to them as we go through, because I think there are some important lessons that I have learned over the years, and I'd like to try to use the opportunity of explaining those to you today, if I can. And it's always best with some examples. Just from an organizational point of view, I have developed the presentation in 5 sections. Certainly for the first 3, I would ask you if you have questions. There's not so many slides in each section. If you have questions, can you just leave them till the end of the section, then we can stop and look back. It's just that the slides are we need to go through each of them, and it might cut off some of the questions before we get to them. You'll have to forgive me, I normally don't refer to notes when I speak, I don't like it, but I think I'm going to have to today, so forgive me if I occasionally look down while we're doing this. The last thing I want to say, as Alexander said, I have been involved in risk management in one way or another for 35 odd years, but in very different ways. I started off my career in banking in IT, actually, IT and quantitative analytics. And in the sort of mid to late 80s, I was part of a small team that was writing and deploying option pricing models in a bank called Bankers Trust, and we'll talk a little bit about Bankers Trust later because it was important in the history of risk management. From that, I went on to become a derivatives trader of various different underlying asset classes, which I did on and off in different roles for around 15 years. And then the rest of my career was either as a risk manager, running valuation teams, or being a regulator. Being a regulator was probably the least well-paid part of my career, but it was also probably the most interesting because I was a regulator starting from September 2005 until the end of 2007, at which point I went back to the industry. And that's when I did my valuation work. And I'm sure if you think of the history of the financial crisis, you might understand why that was. Anyway, let's start. I just want to get us all onto a common base, if I can. And so there's a few very simple questions where the answers may not be as obvious as you think. And let's just go quickly through each of those. And then if you have any questions about that, let's discuss them. So the first question, very simply, what is risk? And actually in the world of risk management, there are at least two separate answers to that. In the world of risk management in financial institutions, although Alexander and I were arguing about this yesterday, my position is that every CRO that you find will share the same definition. Risk is what happens to you on the downside. Risk is associated with loss. It's not associated with unexpected upside. Traders will tell you that that's their skill. But I would look at it that if we misassess the upside, it should lead us to question the models that we're using to try to understand the risk of taking a position. But I've never yet seen anybody say, well, there's a risk we're going to make too much money from that position, okay? If you read ISO 31000, and I mean, this is not, if you can't sleep well, maybe read ISO 31000. It's not the most interesting document in the world, but it contains some very important definitions, and it defines risk, as written there, the effect of uncertainty on objectives. So it's two-tailed. And I attended, probably 10 years ago now, maybe less, a short course in London on operational risk, or enterprise risk management, but basically operational risk. And it was very interesting because there were financial risk managers in the room, we were about 50%, and corporate risk managers in the room. And all of the corporate risk managers sit on the right-hand side of this slide, and all the financial risk managers on the left-hand side. I can probably explain why, because if you look at what banking is, it's about taking financial risk. If you look at what the core type of financial risk that banks take is, it's credit risk. Well, credit risk doesn't have a big upside. If I'm going to lend somebody money, my upside is they pay it back to me, okay? My downside is they don't pay it back to me. So you have a very asymmetrical pattern of risk in credit. And I think that's why we tend to consider, my guess, that risk is simply a downside concept. But throughout the presentation, I will use that definition of risk. Second question, what is risk management? Google it. You'll get a lot of different answers. Generally, you'll wind up with some sort of diagram like this. And I don't intend to spend a lot of time on it, but I think we just need to go around it. Risk management is a process. And it's a process that can exist at different levels. We can talk about managing a single risk. If you want to talk about the history of risk management of single risks, well, let's go back 3,000 years. You can find contracts which transferred risk from one person to another. Merchants who were financing their cargoes that they were shipping could finance them conditional upon the cargo actually arriving. So there were financiers 3,000 years ago who were willing to take from the merchants specific risks. But when we talk about risk management today, when I'm talking about risk management in banks, I'm talking about the process of managing risk at the level of the organization. Yes, there are sub-levels to it, but we need to have a picture, a total picture of the risks that we're facing, and only then can we decide what we want to do with those risks, okay? If you look at them one by one, it's fine, but without that comprehensive understanding, there's an awful lot that can fall between the cracks, and there's an awful lot that you cannot understand about the behavior of your balance sheet as a whole, okay? But the process, I mean, let's talk about it very quickly. I mean, we need to start somewhere. It's circular. Start with risk identification. What risks are out there? What risks can we think about? What risks do we observe from what we're doing day by day? You can say, okay, there's a risk that somebody's not going to pay me back. I need to analyze or assess that risk. And by the way, there's very little standardization in the terms that people use. You'll see risk assessment, risk analysis, risk evaluation, and you read on different diagrams, the definitions are just different on each of them. But from my perspective, risk analysis is about understanding the sources and consequences of that risk. Risk analysis, risk evaluation. See, I'm even confusing myself now. Risk evaluation is about understanding the importance of that risk to us, okay? So does it matter to me? Does it matter to my bank? Does it matter to the organization? Risk treatment is, after we've understood is it an important risk to us, what are we going to do about it? Are we going to avoid it? Are we going to accept it? Are we going to try to change it? Are we going to try to mitigate it? Are we going to try to give it to somebody else? And monitoring, extremely important, because risk crystallizes constantly. Sources of risk change. The nature of risk changes. And you may have hedged a risk using an instrument that in practice doesn't work in the way that you think it does. You may have changed the process believing that the result will be X, and then in fact the result is Y. If you don't monitor, you don't observe what's going on, you will never have a complete picture of the risks that you're facing. So this whole thing is a circle. I spent my whole 35 years going around in circles. This might seem like a bit of a jump, but it's a very important topic. And maybe here we'll talk a little bit about one of my favorite banks, Credit Suisse. But let's first sort of have a look at this. Who's responsible for risk management in an organization? My favorite answer is everybody, because pretty much everybody has some role to play in risk management. But let's talk about it from a building blocks point of view, from a governance point of view. Whether it's an English organization, an American one, a Russian one, German, French, there is a governance structure that exists. In Russia, the governance structure would be a supervisory board. There's probably some management board that sits with inside the bank, but that's part of the third block over there. And these days, if it's a bank, in every bank everywhere in the world, I would think by now, there's a risk management department. That wasn't the case maybe 10 years ago, maybe 15 years ago. What are the different roles of those people? Because they all play a very important part in risk management. And if they don't play their roles, it's impossible for one of the blocks to make up for a lack of the others, okay? So the responsibility of the board, the supervisory board in the Russian context, is broadly speaking to give definition to where risks are acceptable and where risks are unacceptable, okay? So risk appetite. And don't get me wrong, you don't get a bunch of eminent board members sitting around a table saying, right, how should we go about this? They are assisted in that process, generally by a risk management department, who will propose a risk appetite, a framework for risk appetite. But the responsibility of that board is to say for the whole of the organization, for management, you can go here, but you can't go there. That is not acceptable to us, okay? Without that, how the hell do management know what they should be doing, what they should be aiming at, whether their plans are even worth considering? So it's extremely important The board is responsible for ensuring that there is an adequate risk management system within the organization. That doesn't mean a computer program, part of it may well be, but it means that there are checks and controls. There's a properly staffed department. Everybody understands their role in the risk management process. Again, it's extremely important that the board sets that tone. Fourth point, or third and fourth points, let's put them together. Ensure the engagement of senior management in the risk management process. Ensure that an adequate risk culture exists. We'll talk a little bit more about risk culture later. Don't worry if the two words don't sit well together for you at the moment. The board meets, depending on the organization, maybe monthly, maybe quarterly. I don't think anywhere would be less than quarterly. But they don't run the organization. They're not there every day, okay? So they need to make sure that the right tone is being set in the organization. The only way they can do that is by influencing senior management. They need to be ensuring that senior management are incentivized, and actually people working within the business are incentivized to behave according to their stated desires for risk. Again, generally through the risk appetite statement and generally also through some qualitative statements about expected behaviors. Okay? The risk management department, as I said, will assist the board, will propose in most circumstances what each of those things should look like, and they will in part be responsible for implementing those. But partly senior management and partly all of the employees are going to be responsible for implementing those. You might think that I would then go from board to management, right? That's kind of what the waterfall looks like. I put risk management department in the middle deliberately, because believe me, that's what it feels like. As a CRO, you feel very often that you are sitting between senior management and the board. You're responsible to the board for ensuring that their desires, their requirements for risk management are being implemented. But factually, day to day, you're part of the senior management team. And if you're not all working together to do this, it won't happen. How many of you, just out of interest, how many of you have been reading the stories of what's happened to an entity called Archegos, they call it capital management, or maybe mismanagement? Anybody? A small number of international banks, very big names, Credit Suisse, Nomura, Goldman Sachs, UBS, Morgan Stanley, between them have lost $10 billion in the last month or so on collapsed trades with this organization. It's what's called a family office, so it's completely unregulated. It's run by a guy called Bill Hwang. Bill Hwang was one of Julian Robertson's proteges from Tiger Management, one of the earliest hedge funds. And through his family office, he was running, I can't even work out the size of the overall position. I'm sure we'll find out at some moment. He was running massively leveraged equity positions implemented through derivative instruments, through equity total return swaps. I'm not going to go into what an equity total return swap is unless we have time and you're that interested. But the important thing is they're invisible. If I transact an equity total return swap, it's working now, with you, you don't know that I've done it. There's no public reporting of this. If I hold a big position in shares, you'll see it because these things are publicly reported, right? So what happened here is a whole bunch of banks did exactly the same trades with this guy. And on a very limited range of stocks, Chinese stocks, and if I'm right, Viacom or Comcast, large US media company. Those shares dropped 33%, which triggered margin calls on the swap, because the swap is a leveraged instrument that the family office couldn't meet. And so some of the counterparties started selling the shares that they were holding to underlie these trades, which pushed the stocks down further. And as a result, at the end of the day, Credit Suisse so far of $10 billion has reported a loss of 4.7, saying that it's going to go to 5.5. $5.5 billion with one customer. Goldman Sachs reported no loss. Interesting, right? Maybe Goldman's position was so much smaller. I don't know. What I do know is that the risk culture in Goldman Sachs and the risk culture in Credit Suisse are very different from each other. And if you look at the history, even the recent history of Credit Suisse, you'll see loss after loss after loss after loss. Traders mismarking books, picking the wrong clients to do business with. I mean, this last one is phenomenal. $5.5 billion on one customer. And at the same time, if you read the newspapers, you'll have seen that Credit Suisse has lost about $3 billion of money for its customers by helping them invest in short-term liquid assets, apparently, that were created by a company called Greensills. Greensills is a UK company that was specializing in what was supposed to be invoice factoring, but actually turned out to be something different. So Credit Suisse, bless them, in the space of a couple of months, have burned about $8 billion. In my view, because they have absolutely the wrong risk culture. They're about, I think, to fire the member of their board who is responsible for it. They already fired the CRO, they already fired the head of investment banking, but that's not enough because the buck stops there, okay? You can read for yourselves the responsibilities of risk management and the responsibilities of management. I think they're fairly obvious. I wanted to make it very clear to you where the responsibilities of the board are. I sit on 2 boards now. I sit on 3, 4 risk committees. Believe me, it's a responsibility you need to take very seriously. It's not about turning up, listening, smiling, signing a few papers. It's hard. It's hard work. How do you know what's going on in an organization? But if you don't do your job there, very little else is going to work. Okay. Maybe I've talked a little bit about this already. Why bother with risk management? Bunch of miserable people sitting in a room somewhere telling you how everything's going to go wrong. Don't do that, it's risky. But it's not really like that. If what we want to do is to maximize the long-term value of the company that we're working in, the bank we're working in, because this is about banks, there are a few things we need to be sure that we're going to do. One is survive, right? The long-term value of things that don't survive is generally fairly low. We also need to prosper. So you can manage risk by eliminating risk. If you eliminate risk, you eliminate chances to make money. Without risk, there's no return. So this is not about getting rid of risk. But we also need to be sufficiently stable. If you want to maximize long-term value, people, investors who are going to buy your stock, who are going to buy your bonds, want to believe that you are competent in doing what you do. If you produce X billion dollars of profit this year, Y billion dollars of loss the year after, X billion dollars of profit again, it's not going to do your valuation much good. So in my view, the task of risk management, good risk management, is clearly to allow organizations to survive, but also to allow them to prosper, and also to ensure that they can be sufficiently predictable to support the value desires of owners, whether it's individual shareholders generally. Okay, this is a little bit tongue-in-cheek, but when I was a regulator in the UK, in 2006, we did a lot of work. I was responsible for market risk in the Financial Services Authority. What that meant was I had a team of technical experts who would assess applications from banks to use their own internal models to calculate capital requirements for market risk. Don't worry, if you missed that, we'll come on to it again later. So I got to see inside Morgan Stanley, I got to see inside Lehman Brothers, I got to see inside Goldman Sachs. Plus, I'd worked for Merrill Lynch, for Bankers Trust, for several European banks. Goldman Sachs is different. I wish I could tell you why. I mean, my own theory is because Goldman Sachs was the last of the major Wall Street firms to be a partnership. So up until 1999, I think, the money that was being risked was the money of identifiable people, the partners of Goldman Sachs. So when people say, well, you want good risk culture, you want good risk attitude, treat it as if it was your own money. Well, it was their own money, okay? They went through an IPO, so they haven't been a partnership now for 21, 22 years. But they just think about risk differently. They understand that what they do is to take risk. They understand that if they do it badly, it's going to hurt them. And therefore, I mean, they go beyond anything that I would have considered I would find. They take people who trade in one asset class and they move them for 2 weeks to go and critique a business that is run by somebody who's trading a completely different asset class. It's fantastic practice, but I've never found anybody else who does it. But if you go through it, I mean, with the exception of one MDB, which was a huge reputational risk for them, and it wasn't really associated with their trading activity, Goldman pretty much every time come out on top, including with Archegos Capital. So, you know, this is just shows you, tongue-in-cheek a little bit, that you want a better share price, do good risk management. It's just so you understand, sorry. The pink line is a SPDR, an exchange-traded fund of banks that are in the S&P index. So this is Goldman versus the sector that it represents over 16 years. Why 16 years? Because that was the longest data series I could find, sorry. Okay. I need to speed up a little bit. 2 more slides, and then you can ask questions. I talked about why I, as a company, might want good risk management, but I'm talking about banks, right? Banks play a role in society and can damage society in a way that is reasonably unique. I mean, the banks are not monopolies in most places. I mean, they're banking. No, I'm sorry. They're not monopolies in most places, but they do provide critical services. And I think history tells us that natural competition is not enough to protect those services. More is needed because people can get hurt when those services, when those banks fail. Okay. So banks are subject to regulation. Regulation is normally something that's associated with monopolies, where there's absolutely no incentive to think of society as a whole, and there's absolutely no competition to force you to do so. But banks are very heavily regulated. The aim of that regulation, the principal aim of that regulation is not to stop banks from failing. Well, at least that's what the FSA used to say when I worked there, although I think after the crisis they probably changed their mind. It's to make bank failures costless for society. So the cost of the bank failure is paid by its owners, its employees as well, etc. But society as a whole doesn't need to pay for the fact that a bank failed. It's a pretty relevant point to us here in Russia because we've had so many banks have failed. And the cost of the failure of those banks is being borne collectively. GFC, global financial crisis, right? Was a real wake-up call in many, many senses, and we'll come on to that a bit later. But the effect of the global financial crisis was to transfer enormous costs from the failure of banks onto all of us. All of us who are taxpayers, all of us who are depositors, all of us in society. And that was such a shocking set of events. I mean, if you look at the transfer of ownership, if you look at the transfer of risk from privately run, shareholder-owned institutions to the public sector, to government, effectively to us, it was beyond anything that anybody could consider reasonable. And so there's a very, very, very strong desire after the crisis to make sure that nothing like that can happen again. And that has had an enormous impact on the path of risk management in banks ever since. And that we'll talk about in more detail in our fourth segment. Okay, that's the first bit. If anybody has questions, I'm more than happy to try to answer them. Any question, all questions are good. If not, I'll just carry on and, yep.
Yeah, so my question is, the risks of the crisis are the same. Which is between, like, the crisis and the risks are the same. Or
The crisis and...
yeah, because the crisis, I have heard a professor from Harvard University has lectured said in the Chinese, the crisis is reaching which means you could see the opportunity from the risk.
I think that it's a very interesting point, and it's actually very true because the crisis did create opportunity, but that opportunity was created at an enormous cost. The opportunity was created from the money that had been lost by others to that point. But I mean, I can give you a very concrete example. After the failure of Lehman Brothers, you could buy at some point senior unsecured debt at 8 cents on the dollar. Now, in some entities of Lehman Brothers, the recovery was more than 100%. Lehman was at least close to, in the end, a solvent failure. So there wasn't a material loss of value. So the crisis absolutely created an opportunity. Who paid for that opportunity? The guys who bought the debt at 100 and sold it at 8. So, I mean, look, as a trader, where there's volatility, there's opportunity. The worst thing for any trader is markets that go nowhere. Well, what are you going to do? You're just going to sit and hold bonds and earn a coupon, or hold equities and earn a dividend? It's not interesting. So always from volatility, there's opportunity. And a crisis is extreme volatility. It's a dislocation. But I mean, believe me, the sums of money that were lost were just incredible. Any other questions? No? Okay. Let me try to speed up a little bit, because I think, I hope actually most of what I'm going to say is next is going to be very obvious to you. But I suppose it's also one of the lessons of risk management. Nothing is ever obvious. Nothing is too obvious. There's no such thing as a stupid question. In fact, some of the biggest mistakes people make in risk management is by assuming the answer to the most simple of questions. Never assume anything. But why are banks different? Why am I standing here talking about risk management in banks and not just talking about risk management generally? Well, what do banks do? Very, very, very simplified model. I mean, I understand Bank will deliver your food, it will probably do your washing, many other banks will do many other things. But fundamentally, what does a bank do? It enables you to store your liquid wealth. It's what deposits are. Even short-term wealth, that's not explicitly a deposit. Your employer pays you on Thursday, but he pays you once a month. So you need that money to be available to you in ever-diminishing quantities for a month. Where do you keep it? Typically in a bank. Just so you understand the scale of it, I figured bank deposits to GDP was, you can get the sense of it, right? So in the US, in 2017, total bank deposits were 81% of US GDP. It's quite a big number. In Russia, 48%. Well, I mean, it's not surprising that the number is lower, simply because there's less liquid wealth. In the US, approximately 25% of US bank deposits, so do the math, about 20% of US GDP is demand deposits. It's money that the people who it belongs to can walk into the bank tomorrow and say, I want it back. That's a pretty big sum if the entire US banking system needed to cough up tomorrow 20% of US annual GDP. Banks have a critical role, and they still have a critical role today, although you could argue that role is diminishing in the movement of money. And the movement of money is a very important thing to all of us. It's so important that we don't even think about it. And believe me, after the crisis, and when I was in the process of leaving the regulator, when you leave the regulator, they make you sit for 3 months in what they call purdah. It means you're not allowed to do anything with any company So you have to work only on internal projects. I was very lucky. I got sat on a project that was looking at critical banking functions. What are those things that banks do that we can't live without? Because believe me, at the end of 2007, people were talking about whether banks should be regulated as utilities, which would be a very interesting step to take. When you look, and this was in the UK, when you look at the pinch points, the points of risk in money distribution, and you understand what would happen if one of the then 5 banks that underpinned the domestic payment system failed, and one of them nearly did, it's terrible. We were looking at scenarios where government would have to support people in socially difficult situations, literally have to give them cash because there was no other way. If the payment network failed, okay, your debit card won't work, your MasterCard won't work because the banks run the last mile of this. So even today, if you read the news here, Azon is in the process of either acquiring or setting up a bank. Why? Well, because actually without a banking license, they can't fulfill all of their desires in terms of using their customer data, in terms of lending money, in terms of moving money. So banks are still important, even though we probably think about payment processing as being much less a banking function these days. And then their fundamental economic function is the provision of credit, right? I mean, what does a bank do? It takes deposits and lends money. The same money, by the way, right? When you put a deposit there, it's not that your money sits in a pile on the floor waiting for you to come and ask for it back, right? So that's what banks do, simply. And we need them to do that. What's a bank balance sheet look like? Very simplified view. There's some assets. Assets are going to be loans, maybe they're going to be some bonds, maybe they're going to be some bits of real estate, whatever. But let's think of a very simple bank. They're loans. It has some liabilities. Most of those liabilities, that's what they owe somebody, right? The deposits that you guys put there, that your parents put there, that whoever put there. Maybe some bonds, maybe they borrow from other banks, maybe they borrow from hedge funds, maybe they borrow from whoever, but this is all money they owe to people. And then a fairly thin slice at the bottom, and I understood actually as I was reading through the presentation this morning, I understood that I gave you a very unhelpful number there. Core equity tier 1. This is the capital that a bank can use to absorb loss. It's shareholders' funds. Okay, so if the bank loses money, the first hit goes to shareholders' funds. Once those shareholders' funds are gone, then they lose other people's money. Broadly speaking, your deposits, right? So I said the average CET1 ratio for large internationally active banks is 15% approximately, and it is. But that ratio is not to assets, it's to what's called risk-weighted assets. And we'll talk a little bit about what are risk-weighted assets later. If you look at what is the capital ratio of a bank compared to its total assets, real, well, never mind whether it's a loan to a government or to an individual, just look at how much capital is a percentage of assets. It's about 1/3 of that. So banks will operate on a leverage ratio of 5% or so, 5-6%. So it's not an awful lot at the end of the day. This is the point I made just now, and we can probably skip over this, but just so you're clear, fractional reserve banking is probably an old-fashioned term because actually in many jurisdictions, the US included, banks no longer hold reserves, an account at the central bank where they're required to keep a certain part of their liabilities. The US completely cancelled reserves in response to COVID. Before they cancelled them, they were a tiny sum anyway. In Russia, there are still reserves. In many other countries, there are still reserves. And the idea of reserves originally was it's what the central bank told you to keep, so that in a badish case of your depositors deciding to turn up and ask for their money back, you had enough access to funds that you could supply it. Central banks generally perform a lender of last resort function. So when your reserves, when your available liquidity that you have access to yourself is not enough, a central bank will lend you money, but that's already risking your and my money, right? I mean, the central bank is simply part of the national balance sheet in one way or another. So, given that people understand at some level or other, I was actually very shocked at the level at which people understand this, but that once people start to go to a bank to demand their money back, a bank can fairly quickly run out of money. You have this issue with the banking system that in order for it to continue to operate, there needs to be confidence in it. And confidence in banks comes from a number of different sources. I've just given a few of them here, but I mean, history and reputation. And part of this is stability of results, for example, right? You might feel perfectly happy to put money in Sberbank, VTB, Альфа-Банк, a bank that was set up yesterday. Maybe you don't feel so confident because you don't really know anything about it. Stability of results. Independent external analysis is not really so relevant for individual depositors because you don't have access to this information. But there are credit rating agencies, Moody's, Standard & Poor's, Fitch, to name a few, whose commercial business is to provide ratings of the credit strength of institutions, including banks. So if I'm a bank and I'm going to lend to somebody, I will for sure, if they have a rating, I will read their rating reports as well as read their accounts, etc. But it's really not available to individual depositors. The fact that banks are supervised, regulated, is part of the confidence building approach. News and rumors, if you like, are the other side. This is what can destroy confidence, and they can destroy confidence incredibly quickly. I joined Альфа-Банк in 2013, but I mean, everybody who works in Альфа-Банк knows the story of 2004, when a series of articles ran in the Russian press that the bank was on the verge of failure. And the fact that those articles were there almost drove the bank to failure because people came and asked for their money back, quite rationally, really. So I wanted to get to the last point because one of the big reactions to the crisis was that many, actually probably most countries, Russia included, re-looked at deposit guarantees. What's a deposit guarantee? It's when your government says, look, don't worry about it. If you have up to X in the bank, even if the bank fails, we'll give you that X back, okay? Deposit guarantees are a very tricky subject, and I could probably give a lecture on deposit guarantees. I'm not going to, don't worry. But we already discussed the first 2 points. But let's look at the third one. Because what really happens, how do deposit guarantee schemes work? I mean, they're funded by the banking system as a whole, but because crises, because bank failures tend to come small bank failures can happen at any time. Major bank failures tend to happen in waves. They happen with a significant downturn or a financial crisis. Or as happened, I mean, look at what happened in Russia in 2014 when we had a number of pretty big banks that all failed. In fact, they didn't fail technically. They were taken into ownership by the central bank. I'm talking about Открытый, Binbank, Pромsvязь, Moskovsky Kreditny, but that was taken into the ownership of Rosneft, which is a different story. Deposit insurance transfers the cost of bad banks to good banks initially. And then if you have a failure, a systemic failure, it transfers the cost to all of us because the deposit guarantee fund doesn't have enough in it from normal ongoing business, and it has to have money lent to it, typically by a central bank or a central government. So I want to tell you that I think that from a risk management perspective, deposit guarantee insurance is a bad thing. I want to tell you that. I know in my heart that I can't tell you that with 100% confidence because, but why do I say it? I say it because deposit guarantee insurance means that you guys, interesting, Time for my afternoon nap. Because of deposit insurance, if you guys want to put up to 1.4 million rubles into a bank, you don't really need to care what bank it is, right? No need to turn my brain on. What do? I look for the highest deposit rate, and I put my 1.4 million rubles there because I know I'm going to get it back. So you don't do your risk management. If you don't do your risk management, because, as I said, everybody is responsible for risk management, what does it mean? It means that there's more risk being transferred to other banks than there need to be. If you all had to think, every ruble I put there, if that bank fails, I might lose it, you might think differently about which bank you want to put your money into. Why do I say I want to say this, but I know I can't? Because it's unfair. Because there's no way that you have access to enough information to enable you to make a fully rational decision there. But in my view, the right solution to this is not deposit insurance, but transparency. And if that transparency were there, it would remove a risk cost that is imposed on the industry as a whole. I think if German Gref is listening to this speech, I doubt he is, but if he is, he will probably call me and thank me because I know he is strongly opposed to deposit insurance because Sberbank is strong. So Sberbank is paying to support all of these other little banks who are offering higher interest rates, okay? So I wanted just to, I understand it's not really core to the risk management in banking topic, other than the fact that the existence of this deposit insurance and the desire of everybody involved in that process not to have to spend that money is yet another source of driving regulation to be tougher and tougher, okay? Okay, that was that section. Question, please. Yeah.
So, could you point some differences in the banking industry overall? I see a lot of differences maybe in financing between Russia and Europe and America.
Okay, I can try. Most of the banks that I worked for in Europe, with two exceptions, were American. Even when I was in Canada, I was working for an American bank. And I'm sort of, I guess the first part of my career was all in US banks. So for me, that's kind of the norm. I think, let me answer the question in two parts. I think that my experience in European banks, I worked in Banco Santander and in Commerzbank. And you need to put this in context. That was in the mid-1990s and then in the early 2000s. Was that risk management was much less well developed. Business was done on a less arm's length basis, so relationship played a bigger role in banking and the risks that you would take on. But that's probably, I mean, those differences are not huge, but I think it probably partly explains why if you look at globally or internationally successful, internationally active banks, they tend to have US roots. Simply because the US banking system was built better to survive across cultures. Russian banking, look, that's a very difficult question for me to answer, especially given my wife is in the room who works for VTB and also some other colleagues who work there. I started in Russian banking because I was one of, I guess, the second wave of people to join VTB Capital. This was an attempt, and actually a pretty good attempt. I say that because my wife was part of setting it up. No, a pretty good attempt to create an investment bank that would operate according to more or less international standards, but with a Russian context. And I mean, in many respects, I think that was actually quite a successful exercise. If you look at VTB today and its business, and you look at VTB's business before it had VTB Capital, its approach to risk was quite different. But at the same time, what's different in Russia is the structure of the economy and the structure of ownership. And so we'll come on to this a little bit later, but really there are two things that kill banks. I mean, the one thing that really kills banks is liquidity, or when there's no liquidity. And the other thing that kills banks is major credit losses. Okay, much less so, by the way. I mean, you can be insolvent as a bank and operate for years. You can't be illiquid and operate. Okay. The difference in Russia, in my view, in risk management, is that it's almost impossible to manage concentration risk unless you are exclusively in the retail or small business segment. And even in the small business segment, it's quite difficult because the economy is very concentrated, and therefore actually much of small business, assuming we're not talking about hairdressers, and much of the small business actually also serves specific industries. So there's a sectoral concentration risk as well. So for me, that's the biggest difficult, well, that's one of two difficulties. The other, which is actually a really significant difficulty, but we won't go into it now, is that capital markets here are very underdeveloped. Even, I mean, yes, there's an equity market. Yes, there are bonds. Yes, you can trade interest rate swaps. There are some futures. There are options. But none of this stuff is liquid. None of it is reliable. And if you want to be able to manage financial risk, you really do need access to instruments that will help you to manage your interest rate risk, your FX risk, etc. FX markets operate more or less normally here, I mean, in terms of reliability and volume, but nothing else does. And so when you need to think about how am I going to manage the interest rate risk on my balance sheet, you need to think in a very different way. And you need to think about managing it more contractually than through market activity. I don't know if that answers the question, but it's...
I'm sorry.
My name is Ivan. I want to ask you, who is usually stronger for your experience, salesman or risk manager?
Oh, you know, funnily enough, I was thinking about that question. Let me not answer it as risk managers and salespeople. Let me answer it as traders and salespeople, because I was either a risk manager or a trader, right? The trader can never get away from the risk that he has or she has on their book. A salesman sells something to a customer, trousers some money, and is happy until the next deal, right? So I suppose if you want to feel like you've done a good day's work, be a trader or a risk manager. If you want to feel like you've made a lot of money and you can have a nice evening, be a salesman. I understand that that's probably a slightly biased answer because I sit firmly on one side, but I mean, especially in the derivatives business, there are a number of salespeople I would still quite like to kill. So, does that help you?
Thank you.
For a very long time. Let's say like it's a bank. Its name is Shanghai Bank, and it's a private bank. So his mission is attract the money from the people living in Shanghai. So when the people put the money in this bank, and the bank will borrow this money to the Shanghai government, so the government can use it to do some infrastructure construction. But the problem is if this bank have, if this economic development, for example, 1 trillion, 1 year in Shanghai, this is GDP, but they use probably 10 trillion to do the infrastructure construction. How is it possible we could, because the bank cannot say no to the government. This is the situation now. And how it is, the risk management can work in this system, I would say. Thank you.
That's an excellent question. And actually there are even some echoes of that to a lesser extent in Russia. And in fact, we were discussing it last night. Look, if you want to measure it by effectiveness, then clearly risk management can't work as effectively in such an environment. But what does that mean if you're the risk manager? It means that, what, you should just shut up and say, I have an impossible job, I'm not going to bother. everything's okay, do it. No, it doesn't. It means that as the risk manager, you need to be saying, these are the risks. They're not acceptable. Why are we taking them? It can be a very uncomfortable existence. Will it be effective? Well, after the first crisis, maybe. I don't know. I mean, the one big lesson in risk management for any senior risk manager, the best time to do anything is right after there's been a big loss, because then people are willing to make decisions they weren't willing to make before, right? So I know it might really not answer your question, because the true answer to your question is probably that effectively risk management can't do anything in that situation. But doing nothing is not the right answer. And all you can hope is that when that event happens, people will remember that that is what their risk management department was telling them, and that going forward, if there is a going forward, we need to do things differently, right? We all make mistakes. It's forgivable to make a mistake. What's not forgivable is to make a mistake and learn nothing from it, right? The same is true here. So I'm sorry, I wish I could tell you there's a fantastic answer, and if you just...
So am I correct to understand the risk management basically is working in the healthy financial system, not in some extremely power system?
Look, in a system where there is no possibility of influencing anything, the effectiveness of risk management is going to be at best low, right? If you have a government-owned bank that is simply raising money from the population to spend on very long-term projects, and if those projects don't pay off, there's no other source of support for that bank, you know, my risk management advice would be don't put your money into that one, okay? And that, I suppose, comes a little bit back to the question on deposit guarantees, right? We all have a responsibility as customers to understand, customers of banks or customers of anything, to understand the risks that we're taking and accept that we're taking those risks and accept those risks rationally. All right? Why do people ride on roller coasters? I mean, best outcome is nothing's going to happen to you other than that you feel sick, right? As a risk manager, I wouldn't do it. There's no upside for me. Why deposit in a bank that is going to take all of that liquidity and invest it in very long-term government projects? Well, unless you have very strong belief that the government is always going to support the bank, because it will always find a way. I mean, if it's yuan, you know, they can always print them if they choose to, right? You need to be rational about it. And actually then the risk manager and the action of customers together might have an influence. But as long as customers are still trotting along and putting their deposits in the bank, we shouldn't fund this infrastructure. Oh, what should we do? Well, we should lend. We're not interested in that. This is a government bank. We want to do that. I mean, that's the truth of it at the end of the day. But it doesn't mean you shouldn't point it out. Sorry, I gave you the same answer 3 times.
David, I think it would be fair also to ask our listeners or our those who have joined us online, whether they have also questions.
Yeah,
since you have made this short Q&A session,
yes.
Whether anybody would like to ask a question. Okay, just in case you would like to raise your hand, and we will then.
Is there a possibility for people online to write their questions?
Yes, it is.
And then maybe that's the easier way, because I can't even know that there's anybody online right now. So Alexandra, if people could write questions, and then maybe you could ask them or ask people.
Yes, in case there are any questions, please just put them into chat, and we will ask David for an answer. Thank you.
If it's a quick one, okay.
Yeah, quick one. You mentioned a whole question. I just thought. Yeah, I know it was a joke, but I thought. Okay. From the career in risk management, has your perspective on day-to-day things has changed? Do you?
Oh, you need to ask my wife that question. Lenchka, has my perspective on day-to-day things changed as a result of me being a risk manager?
Yes.
Okay.
Thank you.
Okay. I mean, the answer is probably no. I mean, I'm an engineer by education. Yeah, I mean, I was always going in one way or another to have a career like this because that's my personality. So.
There's a question from Yana. She has just raised her hand. Yana, if you would like to ask a question, please go ahead.
Thank you very much. And I just wanted to say, David, thank you very much for a very exciting presentation. I have a question, maybe a more particular one, because I'm engaged currently in compliance and anti-money laundering sphere. So I'd like to ask your opinion on, because banks usually face some unpredicted risks, especially in compliance. So how it is possible to maybe anticipate or check what potential risk that might happen that the bank can face? Is there any way to check or anticipate some risk that can bring the environment, for example? Thank you.
Okay, I'm not sure I fully understood the question. Let me try to answer it. I mean, you're asking specifically about non-financial risks, or are you asking about financial risks as well?
I would say, yeah, non-financial mostly.
Okay. Look, I'm not going to hold myself out as an expert on compliance risks, but it is a very big topic. And if you look at risk committees generally also have responsibility for looking at compliance risk and making sure that it is well managed. I think the answer to your question is that increasingly, yes. Compliance is one of those areas where people are making very significant use now of data and of machine learned modeling. Because predicting which client is looking to engage in money laundering is quite a hard thing to do. But over time, you build up a lot of data, and spotting the patterns in that data is not necessarily so easy. And therefore, techniques like machine learned models, using bank internal data, using industry databases, etc., I think is showing some pretty interesting success, rather being better than human judgment. And that's very much a developing theme. It's a developing theme in financial risks as well, and we'll talk a little bit about that in the last section, assuming I manage to get to it. So Jana, I don't know if I really answered your question, but I mean, I think that's where I would go for non-financial risks, where there is the possibility to collect significant amounts of useful data.
Thank you.
Okay, look, this bit is maybe more interesting to me than it is to you, I don't know. It's more interesting to me because this is sort of the story of my career. But I'll try and go through it quickly because I think actually for you the two final sections are going to be more useful. But why did I put this in even? I put this in because actually midway through my time at Alpha as CRO, we started doing internal, it was a little internal university, and I was asked to give a class on risk management. I can't really talk about anything else. And I was really surprised when I explained to people there how new, really, risk management is in banks. That they were surprised, and we said, well, but we thought that risk management in banks had existed for hundreds of years. Well, in some sense, it has. I mean, it's not like banks ever said, well, you want to borrow some money? Here, you want some more? Have some more. Obviously, there's always the process of assessing individual risks, but I'm talking about risk management in terms of at the level of the institution, or at least at the level of aggregated components of business. And that story, in reality, begins in the 1970s. But before we go to it, let's just very quickly talk about the principal types. And there's one missing here, and I guess I'll ask you, is the presentation available? If people read it, I might be cheating if I ask a question. No? Okay. All right. So here are three of the four principal types of banking risk. Credit risk, very simply, I lend you money and you don't pay it back to me. Okay, it's the most fundamental risk we have. And if you look, I'll use this term again, if you look at the distribution of risk-weighted assets on bank balance sheets, you'll see that something like 80% of bank risk-weighted assets are credit risk. Okay, so it's the principal activity, the principal risky activity of banks is lending money. As I said to you, credit risk is asymmetric. My upside is that you do everything that you're supposed to do in the contract, which means you're going to pay me some interest and repay the money that I lent you over the term or at the end. If you don't do it, well, my loss is going to be quite a lot bigger than my gain in most circumstances. I mean, there are areas of specialized credit where there's perhaps a bit more symmetry, but we won't talk about that now because it's not really typical. Market risk. I need to be very careful here. There's two types of market risk. Market risk is the risk that you lose money as a result of changes in the market prices of assets, indexes, instruments, etc. Banks have two types of book. A trading book, where, well, it's what they trade on, where their positions on that trading book are marked to market. So if I buy IBM shares today at 100, tomorrow they drop to 90, I recognize that 10 loss tomorrow. And they have banking book. Banking book is where most stuff gets booked. There's limitations now. All good accountants will tell us there are limitations on what you can put on a banking book. And it's mostly what we'll sit on a banking book is loans, okay? But you also, because you have loans, you need to be funding those loans. So a banking book has credit assets and it has liabilities. And generally speaking, they are mismatched. Banks will borrow for a shorter term than they will lend. Why? Well, because generally you earn from the yield curve. Longer term interest rates tend to be higher than shorter term interest rates. Not always the case. Sometimes the curve will invert, but the typical, and they call it the normal curve, short-term rates are lower than long-term rates. What does that mean? It means there's interest rate risk on the banking book. If I lend you money for 10 years at 10%, and I borrow that money today at 5%, and tomorrow short-term rates go up to 20%, I'm suddenly starting to pay more than I'm charging you for the loan. So I have risk there. But nothing on the banking book is marked to market. And historically, the biggest source of market risk in banks was the banking book. Park it for now, I'll come back to it, but it's important to understand that. Those two are what I would call typically solvency risks. So they have to do with the value of the organization. If you work out what is the value of the balance sheet and it's negative, then broadly speaking, you're insolvent, right? They have an influence on the third one, liquidity risk, but not necessarily the most material influence. Liquidity risk is very important. What is liquidity risk? Liquidity risk is I owe somebody money and I don't have the money to pay them. I have to give you your deposit back tomorrow. Sorry, no cash. I can't operate anymore as a bank. Right? Even if I want to operate as a bank, you don't want me to operate, and the regulator doesn't want me to operate. Right? So unless somebody is going to lend me money very urgently, game over. Flashing on the screen. Solvency risk. Well, look at Ukrainian banks, for example. I think every Ukrainian bank is technically insolvent, but they've been operating that way for years. Many Italian banks are technically insolvent. They're operating because they're not illiquid. So liquidity risk is incredibly important because if you want to survive as a bank, you need to manage it very, very well. Or you need to be very confident that somebody is going to come and lend you the money that you need when you no longer have access to it. One of the impacts of the crisis, by the way, was that, well, we'll come on to that later. Anybody want to tell me which risk, which principal type of risk is missing here? Okay, operational risk. The risk associated with just doing the things that you need to do to work as a bank. And it was actually really came into the consciousness of bank risk managers very recently, and we'll talk about it a little bit later. And it's a phenomenally fascinating subject, even though it sounds as boring as anything. And even when I was first told that I needed to be responsible for operational risk, I wanted to give that away to somebody else. Would have been a horrible mistake if I'd done so. Okay, I want to talk to you very quickly about Bankers Trust. You probably never heard of Bankers Trust, and you're to be forgiven for that, because Bankers Trust sort of disappeared from existence in 1998, 1999. Actually, it still exists. It's called something like Deutsche Bank Trust North Americas, because what was left of Bankers Trust was bought by Deutsche Bank, an institution that is not renowned for its good risk management, I would say. What might amaze you is that what we understand as the framework of banking, modern banking risk management, was invented in Bankers Trust. They didn't invent any phenomenally complex financial mathematics. Actually, none of this is particularly complicated. It all existed. All they needed was developed in the 50s, 60s, early 70s. Okay. What they did was they understood how to implement this. And that was a revolution. There is a phenomenally, for me, a phenomenally interesting paper. I've given you a reference to it there. And unlike ISO 31000, I actually would recommend that you read it. It's really interesting. It's about 13 pages. It won't take you that long. In essence, Bankers Trust implemented the first practical, usable economic capital framework. Bankers Trust worked out how much capital they needed to hold against the risks that they wanted to run. And they used it as a selection tool. It was Charlie Sanford, who was the guy who was the driving force behind this. He ran initially, well, actually initially he was a credit officer, but at this point he ran the treasury and trading operation. He said, you know, very obviously, there's an awful lot more assets out there than there is capital here. So what we need to do is we need to make sure that we're getting the best result from the amount of capital we have. We can choose between all of these assets. How do we choose between them? We like issuers whose names begin with A. We like interest rates of 10% or more. No. Charlie said we need a framework where we can match risk and return, that we can understand that we're deploying our capital in the most effective way. Bankers Trust at that time was kind of a sleepy bank. They started with market risk. Why? Well, two reasons. One was because Charlie was responsible for the trading operation, and that was market risk. The other is because there was data. I mean, you want to do risk management, it helps if you have some data. Risk management through guesswork doesn't work well. But there's a problem with that, because I've already said to you, 80% of the risk-weighted assets in a bank is credit. So we start with something that happened to be under this guy's control, but represented only a fraction of the balance sheet of the bank. So around 1980, I joined Bankers Trust in 1987. Around 1980, they started applying these concepts to the loan market. And they just came up with a process that used the relative judgment of credit officers, the guys who are responsible for the loan portfolio, their part of the loan portfolio. They said to them, rank for your loans in order of quality. And they used proxies. They tried to find credit risky bonds for which there was data, and they would map these relative ranked loans onto those proxies. Was it great? No. Was it better than nothing? By a very long way. All of this was happening at the same time. There's parallel stories right now. That the topic of how do you regulate banks, how do you ensure banks globally have sufficient levels of capital for the risks that they're running, was being very actively discussed, because regulation of banks was very much a national thing. It still today is to some extent a national thing, but there were no global standards. And the BIS, the Bank for International Settlements, which is, if you like, the central banker's bank, and the Basel, although in those days they called it BAL and spelt it differently, committee started working on a standardized approach to capitalizing banks, to taking capital against the risks that the banks ran. The initial approach was published in 1988, was effective from 89 or 90, if I remember correctly, maybe even slightly later. And it was very, very simplistic. But it created standard definitions of capital, and it created standardized risk weights for loan assets. These weights were incredibly simple. If it was a corporate borrower, it didn't matter if it was IBM or your mum's corner shop, the risk weight was 100%. So a loan of $1 million, to a corner shop, already a problem, would be $1 million of risk-weighted assets. If it was a loan to a central government, conveniently the risk weight was 0. So $1 million of loan to the US government shows up as nothing in my risk-weighted assets. I don't need any capital against it. Very convenient for the government. And there were various other risk weights, 10, 20, and 50% for the different asset classes. But it was very crude. But it was a revolution. Now, I want to talk about JP Morgan a little bit, because JP Morgan played a very important role in the development of a very material aspect of risk management and of regulation of banks. And I'm to this day annoyed about it, because actually Bankers Trust should have played this role. They also adopted value at risk approaches. And what Bankers Trust built was a value at risk approach. Okay, where you say, here's my portfolio, let me try to assess what is the volatility of that portfolio, the standard deviation of returns of that portfolio, and then I understand how much capital I need to hold against them, and I'll some multiple of standard deviations of return of the portfolio. The only thing I can be grateful for is that it actually was their first British chairman who popularized this, a guy called Dennis Weatherstone. In 1994, JP Morgan took the incredible step of throwing into the public domain their methodology. They literally published a huge document saying, here, this is how we do market risk. Why did they do it? Well, they did, from what I understand, they did it because they had inside the bank, they had a consultancy that offered risk management services to customers, and it became so popular, they were overwhelmed by it, and they decided that they were going to actually sell this consultancy, which they ultimately did, and this was part of the process of engineering that sale. But this was revolutionary, what happened as a result of this, because in 1996, the Basel Committee, the same guys who came up with this very simple framework, published what became known as the Market Risk Amendment. And the Market Risk Amendment was a revolution in a number of senses. Number one, it was a revolution because this was the industry pushing the regulator to do something, and the regulator did it. These days, that doesn't happen. Number two, because it was the first time that the regulator stepped into the world of portfolio risk. They were willing not to look at an individual transaction and say you need to hold capital against that, but to say, yeah, okay, we understand that the risks in your transactions may offset each other, and therefore you can calculate your risk at the level of a portfolio or a sub-portfolio and hold capital against that. But the real revolution was they said, you can use your own models to do this. No regulator in the world wrote a VaR model and said to the banks, you use that. Right? Regulators are not capable of doing that, and they don't want to accept the liability of doing that. So what they did instead was they said, here are some standards. Your model needs to comply with all of these. We'll assess whether it complies with all of these. Believe me, as a regulator whose job was doing that, it's not an easy thing to do. But here, if we say, okay, you can run your own model that you built yourself, you can calculate your capital requirements, you need to demonstrate to us on an ongoing basis that model works. But if you do all of that, fine, calculate your own capital requirements. Massive step. On the back of that, again, remember, 80% of risk-weighted assets are credit risk. On the back of that, the bank said, well, hey, now let's talk about credit portfolio risk modeling. Makes sense, right? If you have a highly concentrated portfolio of loans, it's more risky than if you have a highly diversified portfolio of loans. If I lend to ice cream makers and umbrella makers, it's probably less risky than if I just lend to ice cream makers, right? Because Whether it's sunny or raining, somebody's making money. Okay, so banks were extremely interested in this. Again, JP Morgan took the lead, and their friends from earlier, Credit Suisse, also. Just by the way, to demonstrate, Credit Suisse don't fail at risk management because they don't have smart people. They do. Both of them tried to push the industry forward with different but similar approaches to credit portfolio modeling, and engaged together with the industry as a whole in a major effort to try to persuade regulators that the next update to the capital standards should be to allow the use of credit portfolio modeling. Okay. I understand this is a big jump from credit portfolio modeling. We'll come back to it in a minute. In the process of building the new regulatory framework, BCBS said, look, we understand that if we do this, we're going to allow more sophisticated banks to put up less capital against the risks that they have today. So today we have X amount of risk in the system, we have Y amount of capital. And explicitly stated in the new standards was that one of their aims was to ensure that the total amount of capital in the banking system did not go down as a result of the new standard. So they were okay to see redistribution, but they understood that without broadening the scope of risks that were included, that needed to be capitalized, there was no possibility that they would maintain the current level of capital. And that was the big initiative, and a very good initiative, by the way, to include operational risk into that set of risks against which a bank must hold capital. Okay, operational risk, I mean, you can read it for yourself. It's a fairly standard definition. Okay, what's interesting is if you look today, the second biggest source of risk-weighted assets in banks is not market risk, it's operational risk. It accounts for somewhere around 15%, which I would never have believed at the time that it was introduced. Okay, so that's my very, very quick bit about the history, and because I understand I need to speed up a little bit, but if there are any questions, yep, well, okay.
Yes, it's more of a two-part question, which the first part is, how does risk management apply to the currency rate or an exchange rate?
How does risk management apply to
currency
FX?
rate or an exchange rate?
Well, I mean, FX, it's captured within market risk. FX exchange rates move, hopefully. So not all of them do, and that's where things can start to get quite interesting. But the approach is no different than the approach to calculating equity risk, or slightly different to the approach for calculating commodity risk.
Okay, and that leads to my secondary question, which is regarding cryptocurrency. Yeah. So, as you know, like the trend is being hyped up for the cryptocurrency, which, for example, Bitcoin is also known as an official U.S. currency under DC's Act. So it basically applies that the United States has two types of currencies, which some suspect can create an internal competition and may change the value of both currencies. What exactly is your opinion? How exactly it can affect the economy and more like global economy overall?
Oh boy. Look,
just going to say thank you straight ahead.
I think that's a question I would say we should discuss afterwards, simply because it's a very big question. I'm not sure I have a very complete answer to it, but it's not really on our path right now. So I apologize, but I'm happy to speak to you afterwards if you want to.
So I have a question when you talk about
The bank trust. I have noticed there is a very interesting bank. It's called Tinkoff in Russia, which I can never find their real bank. Like before, I would like to open their card, but I can never find except online. So I would say like they give the customer very high interest. Is that this bank formal will be the future bank?
Look, Tinkoff, Olga, можно ответить? No, okay. Tinkoff has been incredibly successful as a bank in Russia. And incredibly successful from the perspective that if you look at the valuation, it's one of the very few banks in the world that trades at a significant multiple of its book value. Okay. Why have they been successful? Well, amongst other things, they actually do have extremely good risk management. I know a little bit the CRO of Tinkoff. What's very interesting, and I won't say more than this about Tinkoff, is they take a very different approach to the way that they look at customers. So when you're going to take a risk, you want to understand what the reward for taking that risk is, right? So especially in retail lending, I'm going to have cut-offs. I don't want a customer with that risk profile because I don't think I'm going to earn enough money from it. Tinkoff use an approach called customer lifetime value. So they look at what they believe, and they model what they believe is the value of the customer to them over a much longer horizon than the product that the customer is necessarily taking from the bank now. I can't stand here and tell you that I know exactly what the horizon was. I think I remember it was somewhere around 5 years. So they model the value to them of the customer, and they model the risk to them of the customer. And that, I think, that led them. I mean, if you look at it, if you look at the risk metrics, because they're primarily a retail bank, right? They have some small, well, they've been growing in small business. If you look at their risk costs, relatively speaking, are very high. But the interest rates that they charge for lending are also very high. And as a result, actually, they built what looks like, and it's gone through at least 2 crises now, what looks like an incredibly stable, high-risk retail business model. I'm generally very skeptical about high-risk retail business models. If you look at GE Money Bank, or if you look at Home Credit, for example, they weathered crises much worse than Tinkoff. But, you know, is Tinkoff an accounting fraud? I'm pretty sure it's not. I'm pretty sure that they simply built a better mousetrap. So it's a very interesting bank, and they're quite transparent. I mean, they report, I think, only twice a year, but you can read a lot about them.
So it's not going to be the future bank.
Look, Tinkoff was the future of banking. I think the future of banking is more shifting towards things that we don't think of today as banks, and that's, I mean, look at banking, retail banking in China, for example. I mean, that's done generally by things that until recently were not regulated as banks, right? Why? Because that's where the data was, that's where the access was. So I think the future of banking in many aspects looks quite different from what we see today. What I'm not sure is what the future of banking looks like in respect to deposit taking and maturity transformation, right? So retail banking is one thing, corporate banking is quite a different thing. But I think, look, are there any other questions? Because I'm running a little bit behind here, so. No? Okay, cool. Okay, so let's talk a little bit about where we are now and why we're here, because I tried to give you the impression in the earlier days that the impetus, the drive for risk management was coming from the banks, and it was. It was coming from the banks because the banks understood that they could build themselves better businesses. The Bankers Trust went on to become the derivative powerhouse bank in the early 1990s, having been a very sleepy money market bank. Why? Because they had better risk management, because they had a better understanding of what they did. It gave them the confidence, and I worked there for 8 years, gave them the confidence to take on a lot of risk. The story ended badly, but you can read about that in the paper that I left you the link for. So, the story to the second Basel Accord, which I think most regulators now view as being a mistake, even though it probably isn't as big a mistake as people say it was. Why a mistake? Because they feel, in retrospect, they gave too much away to the banks. The banks felt they didn't give anything like as much as they promised. So going towards the new accord, the banks were pushing to be allowed to have full credit portfolio modeling. For the sophisticated banks, it would have massively reduced their capital requirements. Okay. What did the regulators bring? They brought a limited ability to use models, internal models, but a very specific model. This time they didn't just say use your own. They in effect gave the model to be used to calculate the credit risk of individual loans. So not a portfolio approach, but they did say at the same time, look, this is our first step, and we hold out the hope that in further revisions we will introduce credit portfolio modeling, just so that the industry didn't kill them. They introduced a three pillars approach to prudential regulation. Previously, it was just calculate what your risk assets are, calculate how much capital you need against those risk assets, understanding its credit risk, its market risk. No, that was it, pretty much. They introduced two new pillars. And this is very important because it's a little bit like I was saying to you earlier when we were talking about deposit guarantees. I'm a big fan of transparency because the more information that is available to people, the more responsibility you transfer to them to understand that information and make their own decisions. So the three pillars, pillar one remained more or less as it was with new rules. Pillar three was about transparency. It set up a huge new set of reporting requirements around risk and risk management approaches of the bank. And pillar two, very interesting, pillar two was a bit where the regulator said, and we, taking for ourselves the right to look at your risks as a whole, to look at risks that are not included in pillar one without stipulating a list of those risks. And we, the regulators, will come to our own subjective conclusion about whether you need to hold more capital, not less, more capital as a result of our review of those risks. It introduced a thing that's called in the industry SREP, SREP, Supervisory Review Process. And that was pretty controversial at the time, even though, for example, in the UK, the Bank of England had taken a similar approach for a very long time. It introduced capital charges for operational risk. Never before. The bank's been required to put up capital against losses they might suffer just because their systems didn't work or because somebody committed a fraud, etc., etc. And importantly, remember I told you about interest rate risk that sits on the banking book, not marked to market, but it could be very big. They introduced a very simplistic stress test, basically said shock the yield curve up and down by 200 basis points, and whatever is the bigger change in value, that's the amount of capital you need to put up, okay? And that was Basel II, and it pursued the revolution. It gave banks another area in which they could use their own modeling approaches because, yes, the regulator dictated the model to be used to calculate the RWA, but the RWA calculation relied on the bank's own estimates of probability of default, of exposure of default. So if it's a revolving credit, how much the borrower would have drawn on that at the time they default, and the loss given default. Okay, you'll hear those phrases often when people talk about credit risk. And banks could calculate all of those for themselves. So there's a lot of freedom. Internal ratings-based approaches were introduced in Russia effectively went live in 2015 or 16, when Sberbank were the first bank who received permission to calculate their own ratings internally. Альфа-Банка is just about to embark on using those approaches. They're subject to flaws. The Central Bank of Russia says, okay, if you calculate you need less capital, it can't be less than by more than X percent. And in the first year, X is 10%, and in the second year, X is 20%. In fact, in the revisions to the Basel Accord, there's a global floor that was implemented now of 72.5%. So no bank in the world can get more than a 27.5% reduction in capital requirements from internal models. That's new. When Basel II was first introduced, there were flaws, but they fell away after 3 or 5 years, I don't remember. This was pretty revolutionary, and this went live in 2006. It didn't say anything about liquidity risk, literally nothing. So liquidity risk, remember, this is the thing that kills banks more effectively than any other risk. Liquidity risk was simply left as it was previously in the hands of national regulators. That was a very big mistake, as it turned out. So also in 2006 began the global financial crisis. It began very quietly, and it began in a way in a place that was invisible to many people in Europe. And I remember sitting in a meeting room in the FSA with one of the US regulators from OCC, I think, and we had a big meeting, and at the end of it, he stuck his hand up and said, by the way, any of you guys worried about risk in the non-conforming residential mortgage market? And we all looked at him like he'd landed from Mars, right? But it was actually, as it turned out, an extremely good question, because what was happening in the US mortgage market was that lending standards were dropping rapidly. The non-conforming, I'm not going to go into the structure of the US mortgage market, it's complicated, it takes too long. But the non-conforming segment is that segment where you can't sell your mortgage loans to the government mortgage banks, so Freddie Mac, Fannie Mae, etc. So this was where if you had high-risk loans, they all wound up in the non-conforming segment, and they were securitized, because in the US most mortgage loans are securitized under what was called private label securitization. And this is where the crisis began, and it began very quietly. And I remember writing papers on this when I was inside the FSA. And what was unbelievable when you looked at it were the transmission mechanisms. Because when you looked at these non-conforming mortgages and you looked at them being securitized, and then you saw that the securitizations themselves were being securitized, and then you saw that those securitizations were being put into what were known as ABS conduits, which were non-regulated non-banks that were borrowing short and lending long. The multiplication effect of this was incredible. And so when it started falling apart, it fell apart everywhere. And a little bit like you see, well, you would have seen if you'd looked at it, what happened with the shares underlying the Archegos trades. The collateral underlying all of this dropped precipitously in value. I mean, absolutely. Again, actually, to our friend in Black's question, there was a lot of opportunity that came from the crisis because people lost so much money on these assets. They were priced at levels that in general were not a reflection of their true value. But this is the other type of liquidity risk. When everybody in the market is the same way around, when everybody owns the same asset, it's pretty damn hard to find somebody who's going to buy it from you. Guess who went through this crisis without losing a bucket load of money? Goldman Sachs. Why? Because they were short going into this. They just bought back what they'd sold. Goldman Sachs did extremely well out of the crisis. They weren't very much liked because of it, but they did very well. So actually a little bit to the question, can you anticipate risks? Well, even financial risk, you can anticipate if you're looking for them. You won't always get it right, but when you stop looking, when you stop thinking, is when risks really start to build up. I could tell you a lot of stories about the crisis, but they all would require a much greater understanding of certain types of financial instruments than I think I can reasonably understand that you have. So maybe when we come to teaching a module, see whether some of that can go into there. I know this looks like another jump. If I showed you one slide, only one slide in the presentation, it would be this one. And you may think that's very strange, right? There's nothing technical about this slide. If you want good risk management, you need people to be motivated correctly. You need people to be rewarded correctly. One of the big problems in the banking industry, actually one of the big benefits, I suppose, depending on which side you look at it from, was people got paid enormous amounts of money on the basis of their very short-term performance. Right? This wasn't true for partnerships. Partners got repaid over very long periods of time. If their capital built over time, they didn't go through a crisis and lose it all. But it was true for traders employed in a typical bank. Remember I talked about mark-to-market. So I buy something for 100, it goes up to 200. That 100 goes into my P&L today. I get to the end of the year, it's at 300. I made 200, fantastic. I'm still long the asset. What happens if on January the 2nd it goes to 50? I have a very, very nice profit this year on which I made a nice bonus, and next year there's a 250 loss. Okay, what do? I leave and I go to another bank. Maybe in that other bank I buy back this asset at 50. Well, first of course, absolutely. But then bonuses are paid out on an annual cycle based on mark-to-market profits. It encourages, in of itself, a bad risk culture. People don't think about long-term. People think about how do I get to bonus day and make sure there's enough P&L on my book. So one of the biggest lessons of the crisis, in my view, is that if you get your motivation schemes wrong, if you get your payment schemes wrong, if you get your culture wrong, you encourage people to do the things that you don't want them to do. And there's a big asymmetry here between the motivation of an individual and the needs of the organization. The more you allow that difference to exist, the less you can control risk in your organization. And there's been an enormous amount, I'm sure you've all read stories about bonus caps, about malice, where banks can claim back in subsequent years money that they paid you as a bonus that they shouldn't have paid you. And all of these things work to some extent and are problematic to some extent. But there is so much more focus on that today than there was previously. I mean, you can call me a hypocrite here. I enjoyed, while I was a trader, I enjoyed that system. I had a good year, I got paid well. I stand here today and I tell you it's a very bad system. And my view today is much more honest than my view was before, I guess. I can't overemphasize this. Motivate people wrongly, they'll do the wrong thing. Changing that is very hard. What's good risk culture mean? It's hard to explain to people. It means you need to understand what your role is and what responsibilities come with that role and accept them and demonstrate them. But this is what it feels like to try to change the risk culture of an organization, believe me. And the CRO isn't the blue and green thing, or the green and red thing, or whatever color. Let's go, what color is it, blue or green? Okay. Okay. What was the result of all of this? What's happened to risk management as a result of the crisis? The boot's on the other foot. The risk management agenda is and has been now for 13 years run by the regulators. As a CRO, the set of responsibilities that are on you is enormous and growing. At least in the UK, I'm not sure about in other jurisdictions. The CRO is even required to vouch for the viability of the business model of the bank. So actually, you go back to remember what I was saying about the view of financial risk managers being that risk is on the downside. Actually, making CROs vouch for the viability of the business model also means that the CRO needs to be thinking about the upside. That's a pretty big change. The independence of CROs has been significantly increased. It's very hard to hire and fire chief risk officers without the consent of supervisory boards, management boards. So if they're taking their responsibilities seriously, that's hopefully a good thing. The engagement of boards, the requirement, even in Russia now, every supervisory board must have a risk committee. It does make a difference, believe me, it really does make a difference. I advised the risk committee of Альфа-Банка Russia, which is probably not good governance, and so there's a CRO there as recently as 2 years ago. But it's a serious committee, and it's really increased the engagement of the supervisory board in risk topics. Very material changes in the way that risk must be calculated. The initial reaction after the crisis was to take value at risk for market risk and say, okay, now you need to do a stress value at risk. So you need to calculate what your value at risk is pre-market stress, right? That changes dramatically the amount of capital that you need. And there's a more fundamental review of the way in which modelling of market risk is being undertaken that is in the process of being launched, but we won't talk about it now. It significantly increased the influence of extreme scenarios, stress testing, scenario analysis, reverse stress testing. As a bank, you need to understand what could cause you to fail. And you need to demonstrate to the regulator you've understood it and that you can live through it. It's a good thing. Actually, stress-based limits work quite well. We always need to have a view of risk as to what things might look like if the world tomorrow is as the world is today. And if the world tomorrow is something rather less expected. Okay? I understand I'm running very late here, so I'm not going to stop. I'm going to go through to the end, and then whatever time we have left, questions, if you're okay with that. So I want to talk a little bit about the future. I'm not sure how qualified I am to talk about the future, but let's have a go. You go to a high-level conference on risk management, I guarantee you that in one way or another these topics will be on the agenda, and they should be. I'm going to focus actually mostly on the last one because in my view it's a theme that is more actual today. It's something that you know that you need to work with, and it's pretty clear what you need to do. But let's just go through quickly. Climate risk. So risks arising from the process of global climate change. Broadly speaking, they divide into two. There's a physical risk. I'm operating in an area that is going to be uninhabitable if temperatures rise by more than another 1 or 2 degrees. Or I'm operating, I have a big data center in a basement in a region where flooding is becoming more likely, right? Banks are exposed to those risks, but it's not typically the major source of risk, at least for European banks, okay? You can't ignore it, but in my view, it's unlikely that banks are going to find a lot of direct risk, or again, European banks, Russian banks. But you have transition risk, because the impetus is that we should move to a lower carbon world, right? Well, when we think about Russia, Russia is a high carbon economy. So if we move to the low carbon world, there are implications. Well, not for banks. Banks don't typically dig up hydrocarbons, right? But their customers do. People they lend money to do. So we can't not think about this. What we can do about it, well, it's a little bit like the Shanghai Bank example. I mean, maybe there isn't as much that we can do about it as we would like to. If every Russian bank today says, "Oh, climate risk, I'm not lending to the carbon extraction industry," that would have some pretty significant negative consequences for the country. So our options are not unlimited, but it doesn't mean that we don't need to think about it. BCBS, Basel Committee on Banking Supervision, last year, carried out a survey of its members. Its members are central banks. So it sent a questionnaire to central banks who are members of, including the Central Bank of Russia, to ask to what extent climate risk was a theme for them. What were they doing? Central Bank of Russia, because it always does, ticked every box to say that it's doing everything that's absolutely possible. And after having sent back that questionnaire, started doing things. So in fact, the Central Bank of Russia has become actually really quite more active, not only in terms of climate risk, but in the next topic that we're going to discuss. And that's a good thing. Because again, we can't not think about this. In a sense, the good thing about climate risk is we have the frameworks within which we can assess those risks. We have a credit risk framework, we have an operational risk framework. What we don't have is the, if you like, the framework for including those risks within those frameworks, and we don't have the framework for aggregating those risks, because at some point you need to answer the question, how much climate risk do I have? I don't even know how you measure climate risk and what units. But you need to think now about how you will do that. ESG investment and regulation. Olga threatened to fire me if I don't include this. But actually, it's a theme that's gathering a lot of momentum in Europe. Counting Russia as part of Europe here, because it's definitely getting a lot of momentum here. What is ESG? Environmental, social responsibility, governance. So it's sort of three qualitative components. Where does ESG come from? Actually, primarily it's an investment doctrine. So it says, if my business is investing in companies, so I'm an equity fund or whatever, typically, how have I done that historically? I've looked at financial returns. I've tried to invest in the companies that are going to give me the best financial return. In an ESG compliant environment, you need also to build a framework that accounts for those companies' credentials in environmental protection, let's say, in social responsibility, which covers a very, very large range of activities, and in governance. Now, how does that correlate on investment returns? If I'm an investment manager, what do my clients want from me? Do they want me to have a portfolio of virtuous stocks, or do they want me to give them the biggest return that's possible? And that's quite a difficult question for investment managers to answer. In Europe, they've been trying to answer it much more, well, they've been putting a lot more effort into it than in the US. And there was a very interesting article 2 days ago in the Financial Times. In the first quarter of 2021, investment into European exchange-traded funds, so, well, themed collective investment vehicles that trade on a stock exchange. For the first time ever, the investment into ESG funds was bigger than the investment into all other funds combined. Well, it wasn't a huge difference, like 52-48 or something in percentages, but as you probably know, 52-48 is enough for a country to leave the European Union. So that's quite a big difference. In the US, anybody want to guess what that proportion was for the same period? 397. So 97% of investment in ETFs in the US in the first quarter of 2021 was not into ESG compliant funds. And for those of you who like to follow politics, you understand that there has been a certain amount of volatility, even in the belief in climate change, at a political level in the US over the last 5 years, let's say. So it's difficult to say, honestly for me, difficult to say where ESG will go, how quickly it will go there, and what the end game will look like. Can you ignore it? No, you can't. Again, you have direct and indirect risks that you need to think about here. If you're a bank and you get your capital by selling shares, you need to think about who's going to buy your shares based on your current ESG profile. Even if you don't issue shares, if you issue bonds, you need to think about your ESG profile. I was asking my ex-colleague, the CFO of Альфа-Банк, how frequently he gets asked questions by investors about Альфа-Bank's ESG approach. He told me all the time now. So you need to think about it. You need to think about the impact on your customers. Because if I'm lending money to somebody and part of their business requires them to be able to raise capital, if they have poor ESG credentials, it also is going to limit the places they can go to raise that capital. So once again, we have the frameworks that we can do this within. Broadly speaking, we need to ensure that our credit risk assessment frameworks, maybe to some extent our market risk assessment frameworks, are adapted, and we can ask the right questions. I understand I've focused mostly on E here. E, to me, is the most controversial bit. I think G, you can pretty much understand that if a company has good governance, well, actually, maybe there's a debate to be had about that later, but in my view, companies with good governance generally are likely to generate superior returns. Social responsibility, okay, maybe that's a little bit more difficult to understand what the correlation is with investment return. Sorry, I swallowed a fly. So that's ESG. Cyber risk comes in two forms. It comes in the risk that people try to commit fraud against banks. I'm sure some of you at least read the story when hackers managed to divert a very large SWIFT payment from the Bank of Bangladesh, a life-changing amount. But it also comes in terms of the fraud that is committed against your customers as a bank. And actually, it's in that area. I mean, I think there are two challenges that I see in cyber risk, where I think understanding how to deal with them is a very difficult one. The first is in understanding where the line should be, line of responsibility should be between banks and their customers for protecting against fraud committed against those customers. In Russia, typically today, the attitude of the banks is, hey, if the fraud was committed against you, it's your problem, generally, okay? But even there, even going back a couple of years, I know the central bank was getting very active here in talking to the banks and saying, you know what, we don't actually agree with that view. We think you bear more responsibility than you believe to act in a way to make it difficult for fraud to be committed against your customers. That's certainly the attitude of a number of European central banks. And so a developing risk area is to what extent banks may inherit the risk of fraud committed against their customers. They own it much more fully in Europe than they do here today. The other challenge, and it's a challenge for me as a CRO, it's a challenge for any CRO, cyber risk is a deeply technical subject. I mean, we risk managers, okay, we're probably mostly technical, but we're technical in a different direction. How do you incorporate within a risk management team without duplicating effort? How do you incorporate the skills that you need to ensure that you're capturing cyber risk within your risk management framework? It's part of operational risk. There are several different models that you can use for that. And I really would struggle to tell you that one is better than another one. What I would tell you is employing highly qualified IT specialists in a risk management team is problematic. Even if you can find them, they won't stay. The work you ask them to do is boring for them. But this is the one I just want to sort of focus on. I have 4 minutes. But it's really a very important topic. Quantitative models. Whether you're talking about pricing derivatives, whether you're talking about assessing retail customers as to whether you're willing to lend to them or whatever, you're going to use quantitative models. Quantitative models have been used for a long time in banks, and for a long time banks have lost money because they built bad models or used good models badly. Okay, I mean, I didn't look for a list of the losses. I'm sure you can find one, I'm sure you can create one. It's big and it stretches over years. I come, as I said, from the derivatives world, from quantitative analysis and from trading. So, I mean, I lived this journey. I can tell you that we did improve the governance. We learned from our mistakes. So, you know, models started from traders writing spreadsheets and saying, I know how to price this, and then going to the IT department and telling them, you build this into the system, and or even worse, not bothering and just booking things in spreadsheets and driving operations people mad because they couldn't understand how to settle anything and whatever. But governance improved because we all lost money from doing it badly. And so the building and the use and the implementation of derivative models, it became a sort of self-regulating thing. Once the regulators allowed models to be used on a large scale for the calculation of capital, they inherited this risk, right? I mean, sure, it's a risk for a bank if it thinks it needs less capital than it actually needs from a regulatory perspective, but banks are not as focused on that risk as the regulators are, let's say. If I'm pricing a derivative, I need a relatively limited amount of data to do it. And I probably can reliably access all or most of that data. If I am trying to model or calculate VaR for my entire portfolio, I start to have some real interesting challenges with data quality. Is all of my data correct? Is all of my data synchronous? Does it all come from the same point in time? Are there mistakes in it? Have I got bad points? Have I got repeated points? Have I got missing points, etc.? When you start looking at how you build credit risk models and you understand you need to recalculate probabilities of default for borrowers on a regular basis, the amount of information and the sources of that information just become bigger and bigger and bigger. And as a result, regulators became very, very interested in data quality, and they started insisting, and banks were very resistant to this, but they started insisting on a lot more robustness around data quality. But now we've moved on. We've moved much further on, because we live in a world where there's just an inordinate amount of data available. And we live in a world where demand for instant answers to all questions is growing and growing. And so actually you were talking about Tinkoff. I mean, it's a good example of a bank that understands this. I think most banks understand this now. If you want to be in the retail lending business, if you want to have good customers, you need to think as much about what people call the customer journey as you do about your risk analytics. You need to think about what demands you're putting on the customer to be able to assess whether or not you're going to lend to them. And so banks have tried to simplify and simplify and simplify their loan application processes down to all you need to put in is a passport number and a mobile telephone number, literally, because they can access, one way or another, a lot of data about you. But that much of that data is not traditional data. And so collecting it and ensuring it's of high quality is a challenge because you don't own a lot of this data. And understanding how to build models to use that data is also a challenge because it's data that describes things in a less than fully obvious way, okay? And so what's happened is as the amount of data has grown, the techniques that we're using to assess risks from that data have also become much, much more complex. And I'm pretty sure that any major bank in Russia today has at least some amount of machine learned models that they're using in their retail lending application process. And the problem with that is that those models are complex and often not very transparent. And so what we're sitting on is a world in which we become increasingly reliant on data, much of which we don't ourselves own, and increasingly reliant on models which we know how we've built, but we don't necessarily know today how they're actually working. I mentioned here that we can skip this slide, but I mean, retail credit risk is the area that I would focus on from risk management point of view as being the most prevalent source of risk around non-traditional data, non-traditional modeling. And so we have a really big challenge to understand how we should identify and manage that model risk. I mean, classically, you would use, I don't know, anywhere between 10 and 30 variables based on a logistic or a multiple linear regression model that you built to understand the creditworthiness of the customer. Those models have static relationships over time. So maybe the data is drifting, maybe the model is drifting, but you understand that you have a horizon within which you could work without needing to go and look and understand how that model is typically working. And typically, traditional retail credit application models, you would probably look at whether you need to recalibrate them once every 6 months. So it's a calendar. I built this model 6 months ago. Now I need to validate it and potentially recalibrate it. You can't take that approach here. You really can't. And we learned that the hard way. And so now you need to develop tools that in effect can continuously monitor the quality of the models that you've built and are running. And so that you can understand based on quality triggers or signs that there may be quality triggers, which models you need to go and reassess. So your life becomes very different. And it's much harder. I mean, the tools that you need to be able to do that, I mean, they're available. How good they are at this moment, it's hard to say. Companies like IBM have put a lot of investment into building such models that themselves, by the way, are based on machine learning. But your life changes and your resourcing changes. You don't know how much more work you need to do. And mistakes here, believe me, can be really costly. Model stops working, you stop making good customer selection, and you don't realize that quickly. You can very quickly build a bad portfolio. So I'm sorry that I've rushed the last couple of slides a bit, but I wanted to try to finish on time. I don't think I need to run out of here immediately, so if you guys have time and you want to ask more questions, that's fine. But I wanted to try to finish more or less on time. I hope you found it interesting. Thank you so much for turning out. And if you can give me feedback in whatever form, I would really appreciate it. Okay.
Okay, David, thank you very much for your lecture. Considering the number of questions and the number of participants, the topic is really very interesting and useful.
I figured you'd paid.
So thank you very much for your comment today, and we look forward to your participation in our MCF program next year and the year after, and in the following years. Thank you very much. And guys, if you have questions, so you are free to write David an email or to myself, and I will forward it to David.
Okay.
And we will answer those questions.
Look, guys, from me, thank you very much. I said to my wife, I don't know what I'm going to do if I turn up and the only people in the room are the 4 people who came with me. We were very far from that. As I said, I do hope you found it interesting. 35 years of my life. So. Thank you very much. Only 6 minutes. Around 6 minutes. You're very welcome. Where are you from?
Well, presently like Australia and Cambridge.
Okay, right. Okay. Of course.
Transparency.
Yes.
What do you think about transparency in global size? Because it seems like
No, I disagree. I mean, look, transparency comes. It's not that they can put glass around the building and let everybody watch what they're doing. It comes through reporting. And my experience of reading Goldman Sachs IFRS reporting, well, actually, the IFRS or their US report, there's a lot of information. They